Hi, welcome to Market Call. I'm Lindsay Biscaya. Richard Fogler is on the show today. He is managing director at Kingwest Company, and he will be taking your questions on North American Equities. And you can call us toll-free 1-855-326-6266. You can also email us at marketcall@bnnbloomberg.ca. Good to have you in. Thanks for coming.
Pleasure to be here.
It's been a bit of a rocky morning for both Canada and the U.S. with the jobs reports coming in. But how do you foresee this going after we've got this news today, potential interest rate cuts coming? Are you still optimistic?
I'm always optimistic, so the answer is yes. The big thing is, the economy looks okay. I haven't seen data after the jobs report this morning. Obviously, saw the jobs report, and the forecast for the third quarter in the U.S. was 3%. It's probably going to be still pretty close to that. So, and most of it's in, so it's probably going to be pretty close to that. Pretty good. U.S. Canada, our jobs report's been pretty weak for a couple of periods now. Looks like the economy's weaker than we hoped. It's all tariff related. The interesting thing with the jobs report this morning is with the weaker this time than last time in the States, who's Trump going to fire this time?
Right. We'll have to wait and see what happens there. I
mean, there's going to be some fun on that.
A lot of unpredictability,
yeah,
right?
So we get some fun on that. But I think take away all that stuff. I think things are, there's a good chance of an interest rate cut with or without with or without jobs being weak in the United States, and certainly Trump's pushing hard for that, and that should be positive for the market. The economy's doing okay, and that should be positive for the market. Doesn't look like there's a recession in the wind, and so we should probably have a reasonable stock market.
And you're saying, you expect economic growth to continue, particularly in the U.S.
Exactly, and notwithstanding the fact that there is widespread talk of the market being overpriced or highly priced because it's 25 times earnings. If you pull out the Magnificent Seven, the less magnificent 493 are trading at 16.6 times earnings, and that's not a lot. It's below the average of the last 20 years. And so the market isn't overpriced, and there are lots in it. I mean, we buy 25 stocks in the United States, so we don't care about the market per se, other than the beta part of it influences everything. But we're looking for 25 companies that are quite cheap, and we think that we've got some in this market pretty good. So
you say you're looking for more fundamentally resilient companies, right? Like, what does that look like? What does that mean?
We're only looking for companies that are fundamentally sound, whose businesses will, over the next number of years, increase in value by some substantial amount, usually because something has changed in the market, and we're looking for things that aren't recognized in the stock price. So some calling it cheap in some manner, where our view is different than the consensus view, and that gives us a big opportunity. We've done very well in the 30 years. We've had a return of over 11% for 30 years. So it gives us the opportunity, that strategy works, and it works for a long period of time, and it works well in slowdowns. In the 2000 to 2009 period, where the market was down in the United States, value was up about 50%. We were up 70%. So we have, this kind of strategy has worked it works very well in normal times. It works very, very well, but it works well over longer periods of time. We're looking for companies. We believe that the stock market prices will reflect company values and the increase of company values, but that's in the long run. On any given day, it's jump ball. Okay. And so that's what we do.
Okay, we will be back with Richard Fogler of Kingwest Company taking your questions on North American Equities right after this break. Stay with us. Welcome back. We are taking your questions now. We're going to start with an email coming in from Jules. That email reads, Enghouse ENGH has a nice dividend. Just wondering if I should continue to hold for the dividend and hope that it continues, that it goes up. So the dividend, 5.8% is the yield. That's pretty good. Do you care about that when you're looking at investing in a company?
We care about a dividend because historically a dividend is about a third of the return in the market. So obviously we can't ignore it. However, if you look at the chart of Enghouse, which you've got there, I wouldn't have mentioned that, but since I'm looking at it, the stock has been quite volatile. It's currently, Enghouse is currently paying out a very high proportion of its cash flow to cover that dividend, and therefore not reinvesting substantially in the business. Secondly, part of their thesis, their argument is we take our excess cash flow and buy accretive businesses. So if you look at their revenues, they've been buying businesses but over the last, I think it's 5 years, they've bought 10%, roughly 10% of the current revenue is acquisitions, but revenue hasn't changed one iota. So they're buying companies, putting them on the other, their base revenue is declining to make up for the acquisition. So we're not particularly pleased. That's not the kind of thing we look for. We're looking for companies that are building their business, not staying stable. So, yes, the dividend's pretty good, but we don't buy things for a 6% yield, to 6% return, I should say. And so that would not be my cup of tea. Unless you think there's some reason, which I don't know because I'm not that familiar with the company, unless you think there's some reason why what has been occurring up to date is going to change dramatically. Otherwise, I'd run for something else.
Okay, we're going to go to a caller now. John calling in from London. Hi, John. What's your question?
Hi, Lindsay. Hello, Richard. We all saw the AI chief sitting at the table with Mr. Trump last night. I thought Sam Altman did very well from OpenAI. OpenAI went to an agreement with Broadcom today, which has further consolidated Broadcom's performance. Broadcom beat on earnings yesterday, raised guidance, went up almost 10%. I think it's fundamentally sound, and I think it's growing its business. Is this an ad for me or just a hold? Thank you, Richard.
Okay, thanks for your question. Yeah, Broadcom obviously doing well. Semiconductor supplies some semiconductors as well. So maybe a bright future. What do you think?
It's very simple. They're in the hot part of the market. As you say, the momentum of the business, forget the stock, the momentum of the business is decidedly positive. Everything is good. It's also not cheap. And so, take your pick. In our business, we don't buy companies at high prices because when there's a hiccup, which we can never forecast, the hiccup can be pneumonia in a highly valued stock. So from our position, that would not be something we would buy. But let's face it, the return has been great. And as I said before, I think the stock markets continue to do well. So if this stuff continues along with it, you'll probably have a good ride. But that's your risk and your potential return. How you guess what the market's going to do to me, it's a guess. I don't like making guesses.
And sounds like he already owns a couple of shares as well. So
yeah, it sounds like you own
stock,
some and you've been doing
if you already
well.
have some, maybe hold on, right?
Yeah.
Okay. We're going to go to Triaver next, calling in from Sierra Vista, Arizona. Hi, what's your question?
Hi. Thank you for taking the call. My question is on Uber, the ride-hailing and delivery company. Two parts. I know that it's a positive picture right now, but here's the part I don't understand. Their gross margin in 2018 was close to 55%. It has gone down. It's below 40 now. But the operating margin went from negative to a positive. Can you help us understand why that happened? And secondly, their free cash flow went from negative to currently positive, which is good. But if they invest in all the ride-hailing type stuff, the robotic stuff, wouldn't that decrease? Thank you.
Okay, thank you for your questions.
Okay, so just want to repeat, it's a two-part question. One is on the margins, and secondly on the cash flows.
Yeah,
so let's talk about the margins. When in 2017, Dara Khosrowshahi, you'll note that I can pronounce his last name. I'm one of very few. Dara Khosrowshahi became CEO of the company, and one of his goals was to take a company that has been growing dramatically. We all know that, and generate some profits with it. And he's done that. And so you've seen it in the operating margin, you've seen it in the earnings, and you've seen it in the cash flow. And so that's all good, and we think that's going to continue, and we think you're probably going to see big increases over the next couple of years as well. And we own the stock, I might say. The second part for the free cash flow, I think you got to understand how free cash flow is really made up of gross cash flow, the amount of cash a business actually generates. And then you have to take off what you'd call maintenance cash flow, or maintenance expenditures, excuse me. And that's money that has to be reinvested back in the business in order to maintain its position, to maintain its operating position. And then you make capital expenditures to expand the business. The expansion business is while that reduces free cash flow, the way you defined it, it actually is a positive to the business because you're making investments in high return businesses that will tomorrow generate high returns, and that's what you want to do. That's how businesses grow. They reinvest in their business and get returns on that capital in the future. We think that the self-driving is coming. Uber's in, I think, 9 markets, operating in 9 markets. They'll be in 12 by, I think, the end of the year or the beginning of next year. They're rapidly getting in that business. It is apparently very clear, not to me because I haven't tried it, that self-driving is going to dominate this business in the next number of years. And Waymo, of course, has most of the cars on the road at the moment, doing exceptionally well. Well, I've not tried it. I have friends who have tried it, and they all come away saying it's absolutely fantastic. And but I've not been in the city where they have it. And Uber's got some deals with Waymo, and they're doing some other deals in order to make sure that they are a player in that market. They're the leader in the business. I can't see why they won't be successful when self-driving comes in. And I think the stock has a long way to go over the next 3, 4, 5 years.
Okay. We're going to take a quick break. We'll be back with more questions with Richard Fogler of Kingwest Company, taking your questions on North American Equities. That is right after this. Here's how you can reach us. We'll be right back. Welcome back. We're going to go right back to the phone lines. Michael is calling in from Vancouver. Hi, Michael. What's your question?
My question's on Tesla. I was an initial investor, but I got in early and I got coffee, and they just took over the market, but they weren't hosting IPOs, and there's a few problems with their product overall. So I'm just wondering, if you get an investment now with Elon Musk is lucky to be in the market at all. He just screwed up somewhere and never told anybody. So thank you.
Okay, thank you. Yeah, I mean, Tesla doing quite well. There was some news recently about, trying to incentivize Elon Musk to stay on with the company for a bit. What do you think? It's another pricey stock, too. Yeah,
so first of all, Tesla's trading 176 times earnings, not exactly in the bargain basement category. Second, Mr. Musk's antics in politics has not made him loved by non-Americans for sure. Third, EV sales in general are stalled because it seems that all the tree huggers have bought themselves an electric car, and now you've got to convince them to buy other things. Tesla itself, well, I was having a conversation with someone this morning who just bought a new one. I saw a BYD SUV last week in France 2 weeks ago. You cannot believe how beautiful this thing is. The exterior is beautiful, way nicer than Tesla. The interior looks like a Bentley. It is spectacular, and it's 2/3 the price of a Tesla. We can't buy them in North America. They can buy them in Europe. You see the sales plummeting of Tesla in Europe. I think it's caused by 2 things. One, they don't particularly like Mr. Musk. And number 2, their options between Audi, Mercedes, BYD, some of the other Chinese opportunities are terrific. And so if you want to go upscale, the Mercedes cars are much better, and they're having sales problems themselves, and they're competitively priced with the top Tesla, and they're much nicer interior wise. And so I personally, I think Tesla's all based on, is Musk going to do something special to it? He came out this morning and said he wants 12% of the if he can get the market price of the company at $8.5 trillion, he wants $1 trillion bonus.
Yeah.
That's ridiculous. That is egregious. It's ridiculous. And a board wants to keep him on. The board can do whatever they want. He's appointed them all, so he can do what they're going to do whatever he wants. But anytime a person acts like I want to take advantage of you. That's not a place I would like to invest. He just grabbed a bunch of stock, 3 months ago? Now he's got this new thing. I would stay away. I wouldn't get anywhere near it. But as I say, I don't like high-priced stocks. Mm-hmm. I think demand for this car in particular is declining, and I think demand for the category is not rising as fast as people thought it was. So I think it's got a bunch of negatives. But I didn't own the stock. It's gone up 1 billion%. So maybe I don't know what I'm talking about. But
I mean, there is a lot of competition now coming into the EV market. So
everybody's has this stuff.
Yeah.
And you just saw it this morning. Canada had to back off its criteria for EV, and that's demand related, not supply related.
Okay, we're going to move on now to our next caller, Aria, calling in from St. John's, Newfoundland. Hi.
Hi. First off, happy first week to the new host. Secondly, my question is on Charles Schwab. It is down around 5 to 6% along with other brokerages today. It is cheaper in terms of PE to, let's say, Robinhood, which caters more to retail investors. So would you be buying the dip in Charles Schwab today? Thanks.
Okay, thanks for your question. Yeah, Charles Schwab Financial Services Company. Would you be buying right now, the dip?
Okay, so Charles Schwab's a really good company. It's very well managed. It's got all the right pieces. The company's doing well. I think it's going to continue to well. It's basically going to do according to the market. It's sort of what you'd call a high beta stock. Make your pick on the market. It's going to return say 25% more than the market returns. On the upside, yay, and 25% or more on the downside, boo. Pick your poison on what the market's going to do. Charles Schwab's an interesting way to play it.
Okay. Stanley calling in now from Ottawa, Ontario with a question. Hi, Stanley.
Hi. My question is on the TD Bank. It's had a good run. It looks like it's slowly topping off, but would you still buy it or hold off? Thank you.
Okay. Thanks for your question. Yeah, TD Bank is always a popular one, right? Would you buy?
We own a lot. If we own it, we'd buy it today. If we wouldn't buy it today, we wouldn't continue to own it. So from that perspective, that's probably the best answer I could give you. TD Bank, basically, if you take a look at its chart we put up, if you look at the other banks, the last 2 years, TD has way underperformed the other banks. Once the mess with the U.S. has been put to bed, TD has caught up some of that underperformance, but you've still got. But the company is still, it's a great managed company. The new management seems to be really good. I mean, they're only doing it for 6 months, but he's doing all the right things, just about all the right things. They're having Investor Day, I forget, later this month, I forget what day, it might be the 16th. And they're going to lay out their new strategy. The company has built the eighth largest bank in the United States from scratch in the last 15 years. Very impressive. They've got a lot of way to go. They made the acquisition of Cowen last year. That's been hugely successful. They've been doing all the right things. I think they are personally one of the best managed banks in Canada. I think they have a lot of opportunity in the United States, notwithstanding the cap on the assets of the bank. I don't think that's going to be a big deal. And so I really like it.
Okay, and yeah, just a quick check. September 29th is Investor Day for TD Bank, so
I guess wrong.
Okay, we will be right back. We'll take a look at Richard's past picks when we come back from the break. Stay with us. Welcome back. We are going to take a look now at Richard's past picks from September 11th, 2024. First one is Apollo Global. When you bought it at $108, now $132. Return of 21%, total return 23%. Did quite well in this one. You still holding it?
Yes.
Did you like it? I mean, what do you have to say for it? It looks like it's gone down a bit.
It's gone down a bit. Well, if you go back a little bit farther, it's gone up a ton if you look at the back.
Yeah.
We've owned it for 10 years. I think we paid $17, don't hold me on, something like that. So it's gone up a lot. They are in the private equity business. They are primarily in the credit part of the private equity business. Their business is expanding at 15 to 20% a year, assets. That will drive 15 to 20% profitability over the course of time. We think that this stock will continue to do exceptionally well. And last year's return, if you'll notice, was a lot better and earlier than the year. It has been the last little bit. Private equity which had done very well, has cooled off. We think that's just noise. We think it's coming. The good businesses are growing dramatically. They've added insurance, which is a huge growth business. The U.S. has just approved private equity in 401ks. It's a $13 trillion market, which is currently 1%. Got 1% private equity in it. That should probably rise to 5, 6, 7%. It's a huge opportunity, and most of that money is going to go to the brand names. And if you notice what's happening today, the big brand name companies are trying to get into the brand name distribution business. And we think that these guys are one of them. We think it's going to be a huge success.
Okay. Next one is GFL Environmental, a Canadian waste management company. So recommended at $55.31, now up to $66, almost $67. Return and total return of both 21%. You're still holding this one too?
Still holding this one too.
What do you like about it? You're going to continue to hold? Would you recommend people buy this time?
Well, if we hold it, we'd buy it. So yes.
Okay.
The GFL is really simple. It's a company that's got two things going for it. One, they sold a business last year, generated a lot of cash, brought their finances in line. That's what really pushed the stock up. They now have a lot of cash flow to reinvest in the business. That's been what has driven the business over the last number of years. And they also have the opportunity of improving their operations. So we think profitability will continue to be very strong over the next few years. And the business will grow, and we think you'll get a 20% return for at least the next 3 years on this thing. So we look for a double 3-4 years out.
Last past pick is CI Financial. Now, this company has since been taken private. When you recommended it, though, you did quite well in the meantime. Recommended it at $17, now at $31.
$32.
$32. Thank you. A return of 82%, total return of 86%. But they were taken private, you say, in August.
It went private in August, taken over by Mubadala. Obviously, we don't own it anymore. It was it was good. We didn't expect it to be taken over but it was okay. Although I would have preferred to continue to own it than have it taken over.
Okay. We are going to be back with Richard Fogler of Kingwest Company, taking your questions on North American Equities when we return. Stay with us. We'll be right back. Welcome back. We are going to go right back to the phone lines. Bob is calling in from Toronto. Hi, Bob. What's your question?
Hi. Thanks for taking my call, Lindsay. Richard, just wondering what your thoughts are on, I might have missed some of your comments on CargoJet. It was 140, I don't know, a number of months back. Now it's a little over 100. I think its low is somewhere around 70 or 80. I'm not quite sure. But I'm wondering if you see it as a buy now, and if you think the stock will ever go back to 140. Thanks for your comments.
Okay, thanks for your question. Yeah, I mean, it's down right now. You think it'll ever go back to 140?
So I don't own it, so I have no idea, A. B, the problem with what we see, the reason why I don't own CargoJet, we like to buy companies which have recurring and predictable cash flows. I like CargoJet's in a very, very volatile business, and you can see it if you look at a longer chart. You see that up, down, up, down, up, down. That's not the kind of company we are attracted to. We're looking for businesses that you don't have to own a lot of businesses. You only have to have very few in your life. You might as well own ones that you think you can predict because you're talking about the future with some degree of certainty. And this is very tough. It's been a great business, been a great stock for a number of years, but as I say, we put it in the too tough category.
And you say it's an unpredictable one, right? The too tough category. And is that magnified by everything that's happening right now when it comes to the uncertainty in the U.S., Canada, trade wars, tariffs? Like it doesn't help.
That's certainly not been a help. But I mean, you could take all that stuff out before this. Same thing. I mean, it goes like this.
Yeah.
Goes like this. Stocks go like this on their own. That's tough enough. We want businesses at least that we can feel can go like this. Now, many businesses are cyclical; they're going to go down, but we want to understand what's going to drive them back up, and be very confident that over a 2 or 3 year period, their profitability, their cash flow is going to be stronger than it was before. In this case, it's tough to call, and so as I say, we just have it in the too tough category.
Okay. Another caller from Toronto, Naz, calling in. Hi, Naz. What's your question?
Hi. Good afternoon. Yes, my question was on Bank of Nova Scotia. It's had quite a nice run. Could you share your thoughts on where you think it is right now? Is it still a hold, or should I move on to something else? Thank you.
Okay, thank you. I mean, if we're looking at this chart right here, the 1 year chart, it's looking pretty good. Is it a hold to you?
I prefer TD to Scotia. Scotia, we don't, they made an acquisition of a Tennessee bank. They have about, I think, 20%. Not controlled, not operating. They just have an investment. This is a huge company, and they just a hole in the head from my perspective, unless they have some longer-term views, which I'm not privy to, about taking it over. But at least at the moment, they said it's just an investment. That's not the kind of thing we would look at. We think is positive. So I would look elsewhere, probably to TD or Royal in the banking area.
So that's your preference, but I mean, if you do have Scotiabank right now, would you consider selling it if you're looking at where it's at?
Yeah, I think the future, yes.
Okay. There you go. We'll move on to our next short and sweet answer. We'll move on to our next question now. Philip, it's an email question. Philip writes, I've been a shareholder of Dollarama for the last 9 years. Obviously, have done quite well with it. My question is, what's your long-term projection for the stock? Dollarama doing quite well at the moment. Although there has been some uncertainty. I believe it was the CFO was talking about how consumer spending continues to be unpredictable. What do you think?
The Canadian economy slowed down a little bit, according to the data from the labor force. So let's say that's true. But over a period of time, it's going to grow. And Dollarama's been a superb company. It's extraordinarily well managed. It's in a wonderful position. When the economy slows, people, trade down to it. So Dollarama will do better than average, I think. We don't own the stock because it's always been too expensive, but I think it's a great company, and I would presume it will continue to do well. As they say, we don't own it, so I really can't give you a comment that would be valuable, but it's a great company in a great niche, great management. It's pretty tough to criticize it.
Okay. Yeah, I mean, it looks pretty good right now. We're going to go to another email question, this one from Lexi, and it reads, Richard, would love your thoughts on Alphabet. What are your thoughts on Alphabet? It's been in the news this week. It's looking good right now, but I mean, do you own this one?
We own this one. It's had a great week, partially because the government came out and said they're not going to bust them up. Yay! But not only that, Alphabet is it's the cheapest of the Mag 7, of the Magnificent 7. Trades at 22 times earnings, which is pretty cheap for a business that's growing at 20% a year. The negative is ChatGPT they own 90% of the search business. The story is that ChatGPT will take over the search. They've got Gemini. These guys, I think, the world is going to change a bit with AI. There's no doubt about it. It's going to be ubiquitous, but I think Alphabet's got all sorts of things going for them. Not the least of which I mentioned before, Waymo, which is by far the leader in self-driving cars, which is going to be a huge business, which is valued at zero inside Alphabet, and they've got a few other things like that too. So we think it's very cheap. We think there's no reason to think search is going to disappear, and that happened this week. You saw it this week. They get a nice little court case, and the thing bumps 10%. That's hundreds of billions of dollars just in that one bounce. We like Alphabet a lot.
And they have, right, because of that antitrust case and the outcome of it, they still have kind of a monopoly over
They got 90%. They're 90% of search.
Yeah.
You know, they get paid a ton of money by Apple for putting in their thing. It's, I mean, they paid Apple to stay in there. That will probably continue. Apple's doing deals with ChatGPT too, but but not with search. And we think that's going to be. We think Alphabet's great, cheap.
Yeah.
Cheap business, great business, good stock.
Okay. All right. We're going to be back with Richard Fogler of Kingwest and Company, taking your questions on North American Equities right after this break. Stay with us. Welcome back. We are going to go right back to the phone lines now. Diana calling in from Blue Water Beach, Ontario. Hi, Diana. What's your question?
Oh, hi, Lindsay. Hello, Richard. My question is on Lululemon. I bought it for a lot higher, and the stock keeps dropping. It reported yesterday, missed on revenue, but had a small beat on profit. Should I hold it, sell it, or buy more? Thank you.
It's a good question. I mean, the stock dropped a lot, especially today as well.
How much is it down today?
Today,
9%.
Let me check. When it opened this morning, it was down 20%.
Right.
And then I think last time I checked, it was 15. I'll check for you right now. Oh, there it is. It's down almost 20% again, so 18% at the moment.
Yeah.
I mean, that's not a good outlook, right? This is
certainly not a good
struggling.
It's not a good present. Lululemon is a great business. They do really well. They got great products. They're getting, you know, but there are a bunch of new guys that have come in their space. Aloe, which is a very hot line, which is in their space. Vuori, which is in their space again, and they're another hot line. So what was a space that they really controlled 2 years ago is now. I don't want to say it's crowded, but they got lots of competitors, and I think that's what's accounting for some of this, some of the controversy and consequently the slowdown in their sales. As I say, we don't own it, so you know my knowledge is not that deep on it, but I think because of the additional competition, it would probably cause us to. Well, it's caused us to not want to own it. Let me say that.
Because I know some investors, when they see a dip, that some people feel like that's a time to buy, right? Like, right. I think that's what Diana's asking. Should I buy more right now because they've gone down so much? But it sounds like you really like to know more about the company and know more about what actually might happen in the future with that company. We
don't care about the stock price. We care about the company. The only thing we use the stock price for is it tells us what we can buy it for. If we can buy a company in a big blue blocks for a very small price, we like it. If we have to pay a lot for the big blue blocks, we don't buy it. And so that's the only way we look at the stock market. So we don't look at the charts. I don't care if it's down or up, other than we often look for things that are down because that'll give us some indication of maybe the company is cheap. In this case, as I say, one of the things we want is a company that's got a competitive advantage. Lululemon had a big competitive advantage 3 years ago in the athletic wear department. And that's been slipping a bit. And so that's not, from our perspective, that's not something that would attract us to the company, to the business.
Fair enough. And just one last question on this, and then we will move on. But if you're in Diana's position, it sounds like she owns some shares of Lululemon. It keeps going down. Would you sell at a loss or just hold it for now?
Okay, so as I say, we don't own it.
Yeah.
And so my comment about the stock price, I could tell you what might come off the top of my head, but I don't have the knowledge and I don't have the understanding of the business deep enough to tell you whether you should buy it or not. The only thing I say is we're not looking at it.
Okay. All right, we're going to move on to an email question now. This one coming in from Charles. It reads, opinion on what rail stock to pick up. Do you have any right now?
We own CPKC.
Okay.
We like it. We have made no money in it in a year. So that makes me cry. But
do you have high hopes for it, though?
Yes. The biggest problem is, they've done a great job. They bought Kansas City Southern. That gives them the biggest network Canada through Mexico. It's a wonderful thing, a big advantage over every other rail line. Unfortunately, Mr. Trump came in and tariffed the way out of Mexico, out of Canada, where he seems to like the socialist Mrs. Scheinbrunn, who's the head of of Mexico, and dislike our leaders. And so I think the rails in general, this in particular, will be sloppy until the tariff stuff settles down a little bit. And you see it in the United States. They're now doing joint ventures and things that Burlington Northern is doing sort of a joint venture thing with in order to have a east-west unified line, and so I think there'll be some activity. The industry is tightening up, getting and shrinking a bit, and that's positive for profitability in the industry in general. And rail is a very efficient way to move goods. That's good. Tariff stuff's a bit of a problem.
Yeah, okay. It sounds like you're overall optimistic in the future with that company. We're going to go to a caller now, John, calling in from Milford, Ontario. Hi, John. What's your question?
Good day, Lindsay and Richard. I would like your thought on Royal Bank going forward. I've owned all the banks for a long time. I've doubled, tripled my money on them. And what's your thought on the banking sector going forward? Can you see Royal splitting in the future? Thank you very much. Bye.
Okay. Thank you. A couple of questions there. I guess, first of all, can you see Royal splitting in the future? And then we'll get on to just banks in general.
Yeah, it could split or not. Who cares? I mean, it's what the value of the business is. Who cares whether it's 200 million shares at 15 cents or one share at $200 million? The split doesn't mean anything. I wouldn't think about that one way. The big thing is, you asked about the banking sector. It sounds like you've owned them all. It sounds like you've done really well. You've been getting a good dividend all the way through. The banks, I think one bank once in the last 100 years has decreased the dividend. Otherwise, nobody's ever decreased the dividend. They raise them on roughly 4 out of every 10 years. The banks have been a wonderful thing in Canada. The one thing that has, and so, I wouldn't, I think you're in great shape, and I wouldn't pay tax to sell those to buy something else. The one thing I would say, though, is a banking business very different than it was, say, 5 years ago, 10 years ago. Canadian banking, the banks were 75 or 80% Canadian banking and 20% sort of outside of Canada banking. Now they're roughly 50-50. So the banks have you have to be a little bit more careful about when you're selecting banks, because the ones that have made their non-Canadian banking business, you have to be selective. Some have done better than others. Royal, for example, has a very efficient, very effective U.S. investment banking business, trying now to do a decent retail banking business. They had one before. They bought Centura Bank. I actually knew it pretty well. And it was a really good little bank. And they end up writing the whole thing off. Yeah, the big deal is they write the whole thing off. It hurts a quarter. It doesn't matter. These things are not a big deal, relatively. That wasn't a big deal, relatively speaking. But Royal is cooking on all cylinders, and you saw it in the last report. But they've been doing it all the way along. I mean, it's the best bank in Canada. It's doing great. You can't miss. Okay. I don't think.
Okay.
I hope. Yeah, we're long.
We're going to move on now. Corey is calling in from Brookfield. Oh, no, it's an email. Never mind. And it reads, thoughts on Brookfield Renewables. I understand now what this is all about. Okay, so Brookfield Renewables, what are your thoughts on that company?
So I'll say one thing in general on renewables, which is that renewables, when they started, were in this business, it was all subsidized. The trick was they go in these things, they had subsidies, that was what made them work. Now the renewables, wind and power, are the cheapest way to generate electricity. Data centers is the biggest thing going. The grid, the need for electrical production is enormous today, going to be much more enormous. They build these $500 million data centers by the bucket load, and they're going to be powered a lot by solar and wind. And Brookfield is one of the players in that. Talk about the stock, I wouldn't own Brookfield. I wouldn't own renewables. I would own Brookfield Corp. Why? It's very simple. Brookfield Corp, if you look at it, it owns renewables, business partners, infrastructure. I'm going to miss one. Anyway, it owns 5 things, wealth solutions. If you add up the value of all of those things, it's about 20% more than the current stock price. If you then add the value of the real estate, which they own, it then gets you up to about 35% over the current stock price. So you can buy Brookfield Corp. Oh, Brookfield Asset Management I left out. If you can buy Brookfield Corp for, let's say, 75 cents on the dollar, 80 cents on the dollar, plus asset. It has a carried. I didn't include in that. They have some assets of a carried interest that are related to BAM. Which increase that number. But most importantly, as BAM increases its revenues, they own 75%, or assets, they own 75% of it. Remember, before I said I like private equity, and it's the same thing. BAM is growing at 25%, or 20% a year, and that will keep pushing up Corp. So we like Corp better than the subsidiaries.
And we'll be talking about that more coming up. That's it for calls today, though. Don't go away. Richard will share his top picks coming up after the break. Stay with us. And you can join us Monday on Market Call. Teal Lind will be on the show. He is manager of Lind Equity Fund, and we'll be taking your questions on North American stocks. And if you miss Market Call, you can always check out our daily podcast. You can find it on iHeartRadio and other platforms. And you can also watch full episodes on our YouTube channel. And now we're going to go through top picks with Richard. This first pick, we were just talking about before the break, Brookfield Corp. You like this one because it's made up of 5 different parts. I know you just went through it, but maybe for anyone who's just tuning in, let's talk about it again.
Okay, I'll try and do it briefly. Brookfield Corp we like a lot. It's done very well. I said before, we like private equity. That's their prime business. Brookfield Corp, to say something a little bit different than I said a couple of minutes ago, one of the big things in private equity is building data centers for AI. These are hundreds of millions of dollars properties. And Brookfield has expertise in 2 of the areas that are used in this: real estate and electricity generation through Brookfield Renewables. So we think it's extremely well positioned for what is the next, one of the big investment opportunities for private equity. Having said that, that puts them in a very good light in the future. As I said, it's trading at 75% of net asset value, which is very cheap. It's got a business that's growing. So a growing business, cheap stock, well managed.
That seems to be a good theme, right? It's a growing business, cheap stock. It doesn't seem like you actually, maybe I'm wrong, it doesn't seem like you go for any particular sector. It's more so just
good company, cheap stock, good outlook, happy investor.
And is that the same then for secure waste infrastructure? That's your next top pick?
Same thing. Secure infrastructure, secure waste, which used to be called secure energy. It's a very simple business. They have 2 businesses. One is a transmission business, about 20%, just moves oil and gas. In the West, pipelines, very stable, very secure, very predictable. And they have a waste business. The waste business is, again, cleaning up primarily stuff in the oil and gas business. They've got a number of pipelines, facilities throughout. It's not only 20% of the business drilling related, 80% of it is production related. So it's, again, very stable, very recurring. It's trading at a 12 times, I believe, a 12 times multiple, which is in line with sort of the energy services business. Unfortunately, it's not an energy service business, it's a waste management business. The waste management business sells at multiples of twice that. It is gradually being converted from being looked at by energy service people to waste people. As that progresses, that could be an impact to move the stock. Meantime, it earns 21% on capital. That's higher than the typical waste business. It's higher by a lot than the typical energy business. It's got the opportunity to continue to reinvest in the business. So we think, again, high rate of return, great management. It's got all the ingredients to do very, very well over the next couple of years.
Okay. Last one is Amrise. You were just telling me in the break that this one just recently went public, not too long ago.
Amrise is the North American division of a company called Holcim. It's the largest cement company. Holcim is the largest cement company in the world. They spun off their North American interests. Used to be part of that used to be Lafarge Canada. It was public, went private 15 years ago. Yeah, 25 years ago, I guess. And we actually owned it then. I'd forgotten. But anyway, Amrise is a very simple business. It does cement. It does aggregates primarily. It's got a small roofing business, which is growing very rapidly. It was spun off by Holcim. It's now focused on North America. It's a very competitive advantage business. These businesses are very, very local because the stuff is heavy, so you can't transport it very far. It's very profitable. The president of Holcim left Holcim, which is much larger, to be president of this. Secondly, when it went public, he bought $100 million worth of stock. You can't tell me the name of a president of any company anywhere who's ever put their own money, other than Jamie Dimon at JP Morgan, that's put their own money in a company. It's very rare. This guy's put a lot in. And so we think this is a great opportunity. We think it's do exceptionally well over the next couple of years. Great competitive advantage, great company, cost benefits coming over the next 3 years, margins up. It's got, again, the ingredients for a big win.
Okay. Yeah, I mean, a lot of telltale signs of optimism in the future. Okay.
Hope so.
Thank you for coming in. Appreciate it so much, Richard. And thank you for watching Market Call. We will see you next time.